Welcome to this explainer. Look, if you're an executive, an entrepreneur, or a venture capitalist trying to allocate capital in the middle of today's absolute AI boom, you know the noise is deafening right now. We're talking trillions of dollars in motion. But where is the actual sustainable return on investment? Well, today, we're cutting through the hype to demystify where the real economic value is hiding in the AI ecosystem. Right now, the entire industry is completely obsessed with generating tokens. But here is the hard reality we have to face. A token is not a product. End users do not buy compute, and they certainly don't buy raw tokens. They only care about, and more importantly, they only pay for, actual delivered value.
So, here is our roadmap for today's briefing. We're going to start by looking at historical precedents, because we've seen this movie before. Then we'll build the AI stack from its physical foundation on up, explain why models aren't end products, uncover the massive application layer advantage, map out the global industries being transformed as we speak, and finally, confront the innovator's AI dilemma. Let's get into it.
Section 1. We've seen this movie before. Infrastructure versus value capture. We really need to start with some historical pattern recognition, just to ground this current boom in familiar economic realities.
Think about how technology cycles historically play out. They follow a very strict pattern. Infrastructure builders lay the essential tracks, right? Railroads enabled industrialization, telecom companies enabled the internet, and cloud infrastructure created trillion-dollar beasts like AWS and Azure. But the largest fortunes, the premium pricing, that always accrues to the application layers built on top of that infrastructure. The manufacturers who use the rails, the big web platforms, and specialized SaaS companies like Salesforce and Shopify. It is going to be absolutely no different for artificial intelligence.
Moving to Section 2, the physical foundation of AI, building the stack. Before we even reach that application layer, we have to acknowledge the brutal, highly capital-intensive reality of what makes AI actually run. Because AI is not just some magic happening in the ether, okay? It is a heavy, physical, electricity-driven industry. The stack is built on 5 strict layers. It starts with energy, which moves to silicon, translates into distributed cloud compute, powers the models, and then finally tops out at applications. If you mistake a lower layer for the entire industry, you are guaranteeing terrible capital allocation. And let's talk about energy, because it's the absolute bottleneck right now. Data centers are literally converting electrons into the critical input for AI. By 2026, data centers will consume roughly 6% of all U.S. electricity, and they'll approach 10% by the end of the decade. Globally, we're looking at a 40% surge in demand. Without those electrons, the smartest chips in the world simply do not run. Now, moving up to the silicon and cloud layers, the competitive structure is just brutal. The constraint in production rests largely in one massive choke point in Taiwan, where TSMC is scaling with more than $20 billion in annual capex just to try and keep up. Meanwhile, the cloud hyperscalers, Google, Amazon, Microsoft, are spending hundreds of billions to maintain their positions. They're effectively collecting an infrastructure tax on every single token generated above them. These are pretty much insurmountable moats for new entrants. It's an arms race that only the absolute largest global armies can sustain.
Which brings us to Section 3. Models are not products, the commoditization of cognitive engines. Look, the models are getting all the mainstream hype, but standalone models are facing a rapidly diminishing competitive advantage. We see models from OpenAI, Anthropic, or DeepSeek, and they produce tokens. But remember, a token is just an intermediate good. It is raw cognitive capability. As the industry shifts from training these models to actual inference, the outputs of these massive engines are becoming incredibly interoperable and, frankly, heavily commoditized. And why does that matter? Because customers do not buy tokens. They buy completed legal work. They buy approved loans, validated drug candidates, optimized energy grids, and shipped code. The true wealth generation in this cycle lies entirely in the spread between the declining cost of producing a commoditized token and the immense value of a completed, industry-specific product.
So we need to push back aggressively on some of the mainstream VC hype we're seeing. Wrapping a generic chatbot around a large language model, that is not a defensible business. An all-purpose agent running from a Mac Mini is not going to sustainably serve complex, highly regulated enterprise markets. That takes us to Section 4, the application layer advantage, capturing sustainable value. This is the exact layer where raw intelligence is finally converted into workflows and actual outcomes that enterprise customers will pay top dollar for. To actually capture this value, you have to meet some rigorous requirements. The deepest, most defensible value requires qualified data sets, really deep institutional expertise.
validated audit trails for regulatory compliance, and most importantly, it has to be woven directly into the client's existing systems of record. Think about healthcare for a second. You can't just drop a chatbot into a hospital. You need an application that inherently understands regulated clinical workflows and has years of institutional context baked in. Now that is a defensible asset.
Let's look at Section 5, Transforming Global Industries and Total Addressable Markets. Because right now, we are watching AI applications actively tear through and disrupt massive global sectors. Just look at the scale here. In life sciences, AI is tackling the $2 billion cost of drug discovery head-on, and we'll see multiple AI-designed candidates entering human trials by 2026. Over in defense, autonomous systems are upending these totally anachronistic budgets where a $2 million missile is currently used to shoot down a $40,000 software-guided drone. In energy, AI applications embedded in modern grids are demonstrating 20% cost reductions. And in robotics, beyond all the humanoid hype, we are seeing real disruption in a $20 billion industrial market through advanced agentic manufacturing. It's happening everywhere.
Zooming back in on healthcare operations for a moment. Administrative overhead consumes a staggering 25% of all U.S. healthcare spending. Prior authorization, claims adjudication, mountains of dense paperwork. This bureaucratic juggernaut is the prime, immediate target for targeted AI applications.
And trust me, the smart money knows this. Digital health venture funding hit $4 billion in just the first quarter of 2026 alone. This capital flow totally validates the thesis. Investors are actively hunting for AI applications that have demonstrable, large-scale economic impact in broken systems.
But if you want to see the true vanguard of enterprise AI adoption, look at the financial sector. Finance has always been a highly quantitative industry layered on top of unstructured data. Think credit memos, research reports, and trader chats. By late 2025, over 90% of major financial firms had deployed generative AI in their core functions. And today, over 80% of New York Stock Exchange trades are executed by algorithms. The speed of adoption here is completely unprecedented. Now, we do have to temper the optimism just a bit. There are massive bottlenecks that are going to gatekeep application deployment. Regulation is a huge friction point. We're tracking 200 state-level AI bills in the U.S. in 2026 alone. The industry is moving way faster than regulators can keep up. Furthermore, cybersecurity is now an existential challenge. 68% of financial firms rank AI risk and fraud as top priorities. Think about this for a second. Software ate the world, and now software is the adversary of software. There is essentially no longer a traditional security perimeter around the network edge.
Finally, Section 6, the innovator's AI dilemma, adapt or perish. The center of gravity is firmly shifting to applications, and that creates the ultimate strategic reality for every executive tuning in today. The battle lines are drawn. On one side, you have the legacy software incumbents, your Salesforces, your SAPs, and they are desperately attempting to retrofit AI into their existing seat-based SaaS products. On the other side, you have the new entrants, startups building AI-native architectures from line one of their code, assuming an AI agent, not a human operator, is going to execute the workflow. The incumbents are under a massive threat here, because institutional knowledge alone just isn't enough if a brand new architecture captures all the value they're losing.
So, I will leave you with this final, critical thought. As an executive or an investor navigating this landscape, the companies that hesitate right now, they become case studies. Those that accept cannibalization survive. So you have to ask yourself, will you protect your existing revenue model, or will you aggressively cannibalize it before an AI agent does it for you? The application layer is where the wealth of the next decade is going to be captured. It's time to build.